Hello and welcome. You're watching Business Plus. There are indications of strong economic growth in Asia this year on the back of China's recovery from the pandemic and strong demand coming in from India. The Asian Development Bank ADB has said in a report, even as advanced economies are contributing to a darker global outlook, Asia's developing economies are on course for faster growth, and moderating inflation this year and next year will add to that growth. The ADB forecast says that China's economy will grow at 5% this year and 4.5% next year, an improvement over last year's 3% growth, but slower than the long-term average. India's economy, on the other hand, is expected to grow at a slower pace of 6.4% this year. This follows a 9.1% annual pace of expansion in 21 as it rebounded from the worst of the pandemic, and 6.8% last year. But it's one of the fastest expansions for a major regional economy anywhere in the world. Inflation risks, however, are skewed to the higher side on the back of OPEC's surprise announcement to slash production by 1 million barrels of crude. Now that, of course, is going to be a dampener in the long run, could add to inflation. With me is my colleague Karthik. We will continue to discuss this story and more. But Karthik, coming to you first, interesting development there. Even as it's all gloom and doom in the world economy, India and China are the bright spots as usual.
No surprise there really, Shweta. So what I feel is that it was always fairly obvious that India and China are likely to be the growth drivers for world economy. And the data coming from ADB in the report that they've mentioned continues to impress upon that fact. Now, why is that so? Simply because we are developing economies. We have, of course, we have been laggards in the earlier decades, but over the last 1 decade or so, Asia has been the leading pack, along with, with India and China really leading that race. And India now being a front runner, especially on account of a little bit of mistrust in China and all the havoc that was created around the pandemic, and then the loss of faith in terms of supply chain caused by the Chinese economy. Overall, I think the faith is fairly squarely pinned on India to be the growth driver. Now, I think what is interesting about the report that ADB has released is the fact that it has taken into account the development we saw over the weekend with OPEC Plus, led by Saudi Arabia, deciding to cut down on oil production. So you mentioned that, Shweta, and I think the estimate that they've taken for the per barrel price of crude is in the range of about $88 to $90 per barrel. And that's a significant injunction that they've made in their assumption when it comes to forecasting growth for India.
Okay.
Now, at 6.4%, it is definitely slower than the growth that we have seen last year. But the fact that we are likely to continue to grow despite headwinds globally and looming recession, which keeps getting delayed month on month, quarter on quarter. Okay. But the inherent expectation of a looming recession, I think, is definitely good news that the world is also seeing India to be a growth driver.
Okay. Shubhamoy Bhattacharjee, who is also joining us at this point in time. Shubhamoy, I want to come to you. Do you agree with Karthik's assessment there that India and China, of course, continue to lead the way for Asia at large, and that would be the course in the next coming 1 decade, perhaps?
Well, when we look at growth projections, we don't look at decadal things in that strong way of vision, because numbers are difficult to look at in that ways. But there's no doubt about the fact that a couple of things is happening very clearly for India. One is that because we are now already a $3.4 trillion economy, and by another couple of years we should be a $5 trillion, you can see what's happening to that as a result of the per capita income. That there is going to be a huge number of Indians in the age group of 28, that is less than 30, who will have a very sizable rising feel of per capita income. That creates a very powerful lift-off for consumption. That's a very impressive change of an order for 1.4 billion people, which has not happened after China's growth leap about 2.5 decades ago. So that is the biggest shift that's going to happen in the world. So yes, that definitely is going to be the significant factor. Also the factor that India is putting in very significant investment in infrastructure. And those numbers will start giving their spin-off very soon. So we are talking in terms of the effect of the road networks that is being built, of the ports being developed, of the railway networks coming up, airports. These are going to make a substantial change in the way business happens and business affects Indians. So yes.
Okay, I want to quickly bring you in on a very important aspect that the report has pointed out because it's recent. It also takes into account OPEC's decision to cut crude oil production. What is the impact or a resultant, inflationary pressure that we could see on, Asian economies, in particular China and India?
Well, the first thing is that this makes, the impact will obviously be that the prices will rise. The prices were hovering at less than $70 a barrel, and that's definitely going to come back again towards 80 on an average. But more than that, what's going to happen is that the sanctions that have been created on Russia and the impact of that is going to become quite disastrous in the sense that that sanction structure is not going to work anymore. This is a fundamental problem that the Western nations are going to face. China, India, Korea, Japan, as the largest consumers of oil, would be working in a much more, what I should say, buyer's market, where they will be setting the trends in the price of oil, thanks to this particular cut. Now, why does it happen? Because as the price signal from OPEC changes, it becomes impossible to keep the $60 a barrel sanction limit, which the G7 nations had put on Russia. That sanctions cannot stay. So when that cannot stay and prices move in response to market forces more for a larger number of OPEC countries, OPEC plus we are talking about, then obviously it's much more comfortable and much more easier for banks and insurance companies to take positions surprisingly. Earlier till now, they were like working on the assumption that if any country moves beyond $60 a barrel purchasing price, we will not offer banking services, will not offer insurance services. You can't now work on that because the prices got definitely naturally higher up. So because of that, India, while it will be facing a higher price, India will be able to negotiate on much better terms the price of the oil that it is buying from different countries, including Russia, Saudi Arabia, Iran, which are our three largest trading buyers. So that, I think, is a very fundamental change that happens. It actually, while it raises the prices, it reduces the headache for India. And that is a very fundamental change that's going to happen because of the oil price cut that OPEC has, oil production cut that OPEC has announced. Yes.
Okay. Just to reiterate, you're suggesting that this will put India in a bargaining position, will be beneficial for India in the long run?
Absolutely, absolutely. Because what will happen is that the price was, the assumption was that it will not be that most of the oil that we traded, at least coming out from Russia, will not be above $60 a barrel. Now, if the OPEC prices itself rise up so substantially, then that $60 a barrel actually becomes a bargain. So Russia is able to bargain more. Russia is able to produce more. Russia is able to, get a better market for its price, for its oil. And correspondingly, the entire financial structure of the world, the insurance and banking, for them to assume that there will be two polar different prices working in the oil market is ridiculous. You just can't have that sort of a system. Prices will tend to converge towards a mean. And here you're actually saying that, I'll create a separate mean. How does that work? It can't work. So essentially, India gets into a much better bargaining position because of the price of the production cut. Yes.
But Shubhamoy, would it be possible in the real world for India to negotiate a different per barrel cost with OPEC Plus and a different per barrel cost with Russia? I know it'll all have to converge towards the mean eventually, but is India going to be in a position to really have a hard bargain with the oil producing nations and really impact pricing for crude?
Surprisingly, yes, because India is now the third largest buyer. That's a huge power in terms of buying. Now, what happens is for the OPEC to actually say that I'm going to sell oil to India at $80 or say $85, or as Goldman Sachs is saying, it can even go up to 90. And then Russian oil to come into the market at $60. Beyond that, it's not supposed to be allowed for. I mean, how does that market even operate?
So would it then
there's no
not be...
way that any banking system can actually keep track of two sort of prices.
But
This
then would
entire,
it not...
I mean, that's the reason why President Biden is so annoyed, because he just can't, you can't keep that sort of a market going with two sort of antipodal prices working on. So it actually creates, that's why I say it actually, while it raises prices definitely, and Indian basket, we'll see in the coming days what the Indian basket will look like. But the two prices has essentially, I mean, those two, it'll not work, and the entire sanction system gets shattered very badly. So for us, it becomes much more easy, because we don't have to expose our banks, our insurance companies, our shipping lines to a system where they can be exposed to sanctions more. It actually reduces the pressure on India.
On the contrary, what are the chances that Russia is going to increase its oil prices?
That's right. That's exactly the point. That's exactly where when we'll be coming along to. Because if it does, then because the prices will tend to move towards that side. Now, how do you ensure that a $60 cap works? You either revise it and bring it up upstairs. Well, if you bring it upstairs, then actually you are giving more power to Russia, and then suppose let's assume that the Russian prices are allowed to go up to say $70 a barrel. Yeah. Well, fine, India will say that actually I can buy more oil and at $70, and Russia will be willing to push more instead of keeping the production cut of about 5 lakh barrels per day, which they've done in February. They'll say we'll actually push in more oil. So good for us. We, instead of having to buy something like at 80, 85, we actually get much bigger window to buy Russian oil at something like 70 without having to fall foul of anybody's sanction regime. So for our banks, as I said, for our insurance companies, that's a better condition. So essentially, it's actually created a much bigger big headache for the G7 nations than for India. India can afford to actually take it easier, despite the fact that the prices will start to rise. But that's something that will be changing. Essentially, what it does is it creates as I said, the fundamental point is it creates much more problems for enforcing the sanctions at the current price. Yes. Right.
Now, what happens, let's say, in the context of India continuing to buy oil from Russia? And last I read, I think a third of Russia's total oil production is exported to India versus a fifth of the total production exported to China. But the fact that we are settling our trade with Russia in yuan rather than the US dollar. So what impact is the dollar rupee pricing going to have, especially when we now see it in the context of overall CAD and overall import-export deficit?
That's a good point. What will happen is that that's even more bigger tension for the dollar supremacy, because if the position goes on, or if the fiction caps continues, that G7 will not buy Russian oil, and Russia is selling more oil to India, then India, and as you pointed out, if the prices are allowed to go up to say 70 or something, that means a larger percentage of Indian oil, Indian buy will be settled either at the rupee-ruble transaction or in yuan, which means that that India needs to sequester much less amount of dollar for buying the oil that it needs to. So that creates, it lessens the pressure on India's foreign exchange holdings. For RBI, that becomes much easier to manage in the circumstances. It's much easier to buy yuan in the international market for RBI and have a better bargaining position than have to buy dollars. So,
but Shubhamoy, with such volume of trade with Russia, on the oil front, and the fact that we are settling the trade in yuan, are we actually giving a fillip to the Chinese economy inadvertently? And are we actually helping the cause of China's CAD and China's forex reserves inadvertently?
Good point. So essentially what happens is in the international market, it is about convertibility or rather acceptability. Now, India, obviously, for that reason, you'd find the RBI governor, Mr. Shaktikant Das, saying that we want larger and larger volume of international trade emanating from India to be settled in rupee. Now, as more of that happens, India can therefore, again, that buyer principle, as a large buyer, India can say that I want a particular percentage of my buy to be settled in rupee. Remember,
Exactly.
this is the same principle. It isn't so outlandish. The same principle on which USA put the dollar hegemony in place in 1970s. It's time to pay back that same sequence of events, except that it's now to be determined in rupee and in yuan. So India would say that I want a particular percentage to be settled in rupee. Now the trick there will be, what will be the converter between the rupee ruble? Will it be the dollar number or will it be the yuan number? Now that's your guess as well as mine about which one will be used. But whichever way it is, it becomes definitely a much bigger window for India to create a larger acceptability of the rupee in the international market.
And that is exactly what the focus of the
like
government also is right now with respect to internationalization of the rupee and opening of wash-through accounts. I think, one needs to understand what is holding the government back to impress upon Russia to settle this trade in INR.
Well, one thing that the India government is very clear, and that's a very useful position to have taken, is that India government is saying that, look, I don't want to expose my banks to the volatile world of sanctions and others till the war is not settled.
Right.
India has been saying, in fact, I suspect you would know, a large part of the Russian oil that is being sold to India right now is on credit, in the sense that the money is being, the price is being settled, but the transactions are sort of, not really been paid off, in the sense that India is saying that, look, I'll pay in rupee, and if I pay in rupee, then you have to create the channel for me to pay it, which is bereft of sanctions.
Right.
So the sanctions is right now the biggest issue for India to ensure that there's a larger amount of rupee that is traded, in terms of rupee that is traded with Russia. Because if India allows more banks to trade with Russia, that those banks, if they have exposure to the international markets in Europe and in USA, those banks could run foul of the sanctions. Obviously. And India will not want that, because this is not India's war. So India is saying, look, I'm buying and you give me the sale promise. It's basically the deferred promise to pay. Right. That is what is being done right now. And that is something which is actually working to India's advantage. The kickoff of the rupee-ruble trade formally will have to happen, will have to wait till the war at least is sort of pushed down to the extent that there is an acceptable ceasefire between the two countries, Russia and Ukraine, which the international community also accepts. And the Indian banks are not susceptible to any sanctions pressure. That I think is a very wise decision that India is taking. And as I say, it's an advantage, because after all, the oil has to be sold in India. So India is saying, fine, I'm picking it up, but you'll have to work on my terms,
the modes of payment,
to ensure that I don't have to expose my banks to the payment based on a sanctions regime, on a regime where my banks don't get exposed. You'd find that's why that some of the payments have been made in dirhams. Some of the payments have been made basically on a deferred sort of system, which if you want to look at history, was known as the Lend-Lease system in the Second World War.
That's right.
Something similar is going on between India and Russia at the same time. Yes.
Okay. Coming specifically to India in this case, we're tracking another report released by the World Bank. India's GDP growth, World Bank says, is likely to moderate to 6.3% in financial year 24 due to shrinkage in consumption on the back of slower income. The World Bank has lowered its forecast for India's economic growth in the current fiscal year from 6.6 to 6.4, World Bank, and 6.3. World Bank, in its flagship report, India Development Update Spring 2023, said that rising borrowing cost and slower income growth will weigh in on private consumption. So private consumption there could prove to be a dampener. World Bank projects retail inflation in India to be at around moderate of 6.6 to 5.2% in financial year 24, so which is well within the RBI's tolerance limit from 6.6 at the moment. Inflation could come down to 5.2% in financial year 24. India's current account deficit, CAD, the difference between exports and imports, is also expected to be at 2.1% in the financial year 24. With me, my colleague continues to be here. Shubhamoy is also with us. Karthik, coming to you first. Not a lot of difference there. 0.3% growth forecast lowered for India's, GDP growth. Not a substantial cut down, but something that could affect us in the long run.
I think, the cut down, I believe, has largely come on account of, again, the revision in the fuel prices, which is likely to happen as a result of OPEC Plus cutting down production and rising fuel prices that Shubhamoy was just talking about. What surprises me is the fact that that the World Bank says that the slowdown will happen on account of lowered consumption, and that lowered consumption is on account of lower incomes. So I think largely the problem that we are talking about is employment stroke unemployment. Employment being the opportunity, unemployment being the advantage here. But I think largely the fallacy that I see in this system is consumption likely to slow down. And data, for some reason, doesn't correlate that very well, because I was just going through FADA numbers also, which got released today. Incidentally, Mahavir Jayanti, great day for a lot of reports to be released on a day bereft of news. But FADA numbers have just come in for the month of March, and Y on Y, we are seeing passenger vehicle sales are up 14%, two-wheeler sales are up 12%, commercial vehicle sales are up 10%. So overall, we are seeing that that there is consumption. And just a day or two ago, we had done another story on auto and housing being the real growth drivers for India. Now, apart from these high value purchases, what is left is technically essentials. And I doubt even in an inflationary environment, there is going to be a lot of cut down on essentials or on household items, right, which become a must have rather than a could have or may have. So I wonder what really, is leading to this slowdown in consumption that the World Bank is talking about.
Okay, let's bring Shubhamoy in. Maybe he can fill us in on what exactly is the expectation. Where is consumption missing? Just to reiterate with what Karthik said, there is consumption in the auto space. We tracked the story closely day before yesterday. There is also growing consumption in electronics. There is growing consumption in various other allied sectors. So what exactly is hurting consumption? Is it the pent-up demand? How are you seeing it going forward, Shubhamoy?
Well, what Karthik is saying is right. It's been too far down the COVID line to sort of say that it is just entirely pent-up demand. I do see the fact that consumption is returning to the market. If you look at even further number of figures at the top end, if you look at flights or the number of passengers at the airports, those numbers have almost come close to the 2019-20 numbers, almost 97 or 96%. At the lower end, if you look at the microcredit, when I was looking at them closely, I find that those numbers are actually holding up surprisingly, and actually the credit there has increased, and the default rate there has actually come down very substantially. So definitely, there is very little to suggest that the consumption is hurting. Also, my sense of what the World Bank data is that, first of all, as you would have seen, unlike the pre-COVID periods, because of the fluctuations that's happened in most economies across the world, forecast agencies are essentially going in for what is called quarterly revision. The World Bank does it twice a year, but those twice revisions are essentially based on internal 3-monthly revisions. Most GDP projections by any agencies are therefore good only, according to me, only as a quarterly projection. I would not look at them as something which is a trend for the entire year. They are subject to huge fluctuations, and that will happen. And we shall see more as the data goes along, more numbers coming up later in the year, which will be more accurate. About the only thing that I take it on is that, yes, as everybody has more or less been saying, that FY24 will be slightly tougher than FY23, but for various reasons. And one of the things that will be happening is that the export market is essentially hurting a bit. And when I say export market, I largely mean the export of goods. Because of no fault of India, the fact that the global economy is not really at a best of health, exports are hurting. To the extent that exports hurt, that has a backward linkage into the rest of the economy. And to that extent, the economy gets affected in terms of its production process, in terms of throwback of consumption into those who are working on the export sector, on their income levels, and so on. So that's where the weakness is there in the economy substantially. The other thing I would actually say to reverse it will be the fact that this is the year when there's an election happening, general elections happening in May 24. And before that, we have series of state level elections. In the Indian spending cycle, election years are years when actually consumption rises because more money comes into the economy. I have not seen so far any of the forecast agencies taking this into account, but if they look at consumption behavior of the Indian economy in election years, they would notice that the very fact of the election process tends to raise consumption. So that has to be factored in, and that could actually make the forecasting agencies feel a bit surprised in terms of the actual numbers when it comes later on. But at this stage, that's where I'll stop.
Right. So, Shubhamoy, talk us through the cost of capital in this case, because we've seen, of course, inflation. We've seen the rate hikes to tame inflation. Inflation steam still continues to be sticky. And add to this, of course, companies now picking up capital from banks at a higher interest rate, at some level passing that cost on, which will have a further impact on pricing, on inflation. In this context, do you see demand getting at some level maybe subdued because of the sticky inflation and a higher cost of capital, cost of borrowing?
Well, obviously, when the cost of capital rises, to some extent, that does affect capital expenditure. But I was looking at, say, okay, let's take a sample bank, like an HDFC bank.
Yeah.
I was looking at their credit offtake. Now, that credit offtake number tells me that that after a period of being rather flat, credit offtake has actually begun to rise. And why is that so? Because credit decisions, and I'm talking about long-term credit decisions, these are rising now because they would be the result of both decisions taken about a quarter or more ahead.
Correct.
So, no company would be taking decisions to expand their production capacity based on the cost of money now. They would have been taking it for a couple of, at least about 1.5 quarters ahead, previous.
Right.
So, the impact, if you say what will be the impact of the current cost of capital, that we will see down the line. Right now, what we are seeing is the credit expansion happening and would be happening more substantially because of the price of capital, which it was, say, about a quarter and a half ago, when it was lower. And based on that, companies are basically sure that they will be needing to expand their capacity. The RBI Obicus survey, which essentially looks at what is the capacity that companies are looking at down the line, shows expansionary trend finally taking off substantially.
All right.
Which means that the economy now, you would find more and more companies talking about expanding their production capacity. That is going to take place just as the effect of the latest round of capital cost increase is going to take place further down the line. Right. So we should not be conflating the current cost of capital with what is happening right now in terms of the capital expansion. The capital expansion has already started happening, and it's happening with the project with when the costs of capital was somewhat low. So my sense is that this beneficial effect is going to happen over the better part of 23 calendar year.
Right.
In 24 calendar year, we shall be seeing the softening effect, but that will come later. Right now, therefore, I am not going to be looking at sort of a squeeze, but rather an expansion of credit. Also, the interesting thing to look at is if you look at the cost of capital, the cost of working capital and the cost of long-term capital, the differential between them has narrowed substantially.
Right.
Which means that companies are able to take a punt on investments in machines and plants much more easily than expanding their immediate production.
Absolutely,
So
and that will have a multiplier impact.
Big,
And that's sure to have a multiplier impact, of course, on on their overall operations going forward. But talk us through the inflation target, 5.2, World Bank's calculation, 5.2 versus 6.6. Looks achievable?
Yes, this is more or less fair because if you are talking about initially when the cost of capital rose, what was RBI doing? RBI was essentially saying that the amount of goods and services in the economy hasn't expanded. There's been a COVID shock. So if there's too much money in the economy chasing the same amount of goods and services, obviously there'll be higher inflation. So RBI has consistently raised the cost of capital. Now, because of doing so, while even as RBI has done it, it has sort of raced up behind the rise in money expansion. And the result of that you've seen in terms of the inflation going up beyond 6%. And even the core inflation has gone up to above 6%.
Right.
What is the impact now? We just talked in the last question that we were discussing about the fact that production is now expanding. When production is expanding, the money that is there, RBI has stamped down on the supply of money. It asked money to be squeezed. So what's happening is that there is now a larger supply of production available of both goods and services, with the promise of even larger ones coming through, whereas the supply of money is not rising at that same pace.
Right.
So obviously it stands to reason that the inflationary pressure in the economy has gone past its peak and it has started going down. Now, whether it'll be 5.2 or whether it'll be 5.1 or whether it'll be 5.4 is something that will be depending on seasonal factors. For instance, right now we are going through an unseasonal burst of rains that will have its effect on agricultural production. So that could actually lead to rising in the price of cereals. At the same time, it might actually lead to an improvement in people's purchases of many of other needs of daily things that they would want daily, because they might want to actually go out and spend. So, there are lots of stuff that comes along to adjust that the exact inflation figures. But there's no doubt about the fact that the inflation has peaked and is going to come down as I said, the production has risen and the supply of money is not rising as fast as it was earlier. Yes.
Before I let you go, Shubhamaya, we're hoping to get you back shortly, but RBI's MPC is underway. What are your expectations with respect to rate hike? We know we are expecting, of course, a rate hike, but what are your large, broad expectations there?
Well, last time, as you saw, the vote was divided. And the vote was, and that essentially means that the MPC is not very clear, which is fair enough because the data that they're looking at is not giving a very consistently one-sided view. A couple of cycles earlier, it was very clear that the prices, the money supply was still racing ahead. Now, because of the factors that we're talking about, the inflationary peak has come. It's a question of tamping down on whether the inflation has gone past the peak. According to me, it has gone down. So to that extent, the RBI might decide to hold its horses for the time being, and because as you can see that our US Fed is also talking about raising rates, but not at the aggressive way as it was doing earlier.
Right.
So the need to maintain a differential between the US market and the Indian market, which is also a very significant factor which affects the RBI's decision, is also softening up. So I would tend to think that RBI will possibly be veering towards a holding position right now, saying that this period of inflationary spiral has essentially come to an end.
Okay. Interesting take there. We're going to move on to another important story we're tracking. Shubhamoy, continue to be with us. As of February 2023, there was almost 35,000 crore unclaimed deposits in public sector banks. Now, these unclaimed deposits belong to 10.24 crore accounts and have been transferred to Reserve Bank of India by the end of 2023. Now, unclaimed deposits in public sector banks have shot up 70% in the past 3 years. This according to data shared by the government in Lok Sabha. An unclaimed deposit is a deposit that does not see any activity like an infusion of funds or withdrawal from the depositor for 10 straight years or more and is deemed as an inactive deposit. In most cases, the depositors are presumed to be deceased without a nominee. Now, banks have to report the number of unclaimed deposits and the amount of the same to the RBI. After this, the unclaimed deposits are transferred to central bank's depositors, education and awareness fund. Although banks have been advised to consider launching a special drive for finding the whereabouts of the customers or legal heirs when the accounts become inoperative, there hasn't been much of a headway in this regard. So what are banks actually doing to ensure legal heirs of a bank customer gets the money? We will continue to discuss that and more. My colleague Karthik is with me. Shubhamoy is also joining us. Karthik, coming to you first, it looks like a huge problem, 70% increase in the amount of unclaimed deposits in the past 3 years.
Absolutely. So what worries me is the fact that banks have been very stringent on their KYC norms. They've been very, very strict and vocal with linking of Aadhaar and PAN card, all these documents to be furnished in the KYC, linked back to the account or any other deposit, not just a bank, even an insurance, even any other financial product that one applies for. Or KYC is a very stringent and potent tool today. And we've seen this Aadhaar revolution on and on for the last decade plus now. So I think if banks try hard enough, it should not be very difficult to find the rightful owner of those deposits. Now, in the case of course, a deceased family member, we've seen even nominees being, mandatory as part of any saving bank account, fixed deposit, mutual funds, insurance policies, the works. Any financial product also has a very equal and strong focus on nominees. So the question that definitely needs to be answered is, are banks trying hard enough? And I've seen cases myself. So for example, when I'd taken an auto loan, a car loan way back in 2005, 2006, completed that loan, it was with a bank account. My salary account had moved to another bank account. And over time, I lost track of whatever 8,000, 10,000 rupees that I had in that bank. About 2-3 years later, when I went back to claim, they said, your account is inoperable because it's been lying dormant for a while and you'll have to deposit another 100 rupees. Thereafter, 3 months later, we will issue a demand draft. So I don't know if the demand draft ever got issued or not and whether the bank updated my home address or not, but that draft never reached me. Okay. And over time, one tends to lose maybe, receipts or bank account numbers or customer IDs, etc. And that money is happily resting now, maybe in some vault of the RBI. But I think strict KYC should ensure that the rightful owner gets the money back. Of course, the plus of this is that, the money is not lying with the bank itself. That money is now going back to the central bank, and the central bank is using it for investor education. It is using it for education and awareness purposes, which means it will possibly, harp more upon KYC, harp more upon best practices for banking, and sort of ensure that that less people are in the situation like the 70% rise that we have seen right now.
Okay, we're yet to get our guests, but let me just, a very interesting, important figure there, 35,000 crores.
It's a huge amount.
It is a huge amount.
It's a huge amount.
And it is going towards some developmental cause, but that's the only good thing about it. I think, and in my personal assessment, banks need to do more in order to reach out to the family members.
You
of
have
these
all
accounts.
the details, you have the KYC, you have the address, and these are people who have visited your branches. These are people you have made phone calls to or have tried to have established some communication with. And I see no reason why it would be so difficult to not find 35,000 crore rupees go back to their original beneficiaries.
Absolutely. Important story that we're tracking there. We will, of course, bring you more details on that. But shifting focus for now, net direct tax collections rose by 17.63% year on year to 16.61 lakh crore in the financial year 22-23 compared to 14.12 lakh crore in the preceding fiscal year. What's more, the direct tax mop-up last fiscal, which remember includes taxes from individuals and corporations, crossed both the budget estimates of 14.2 lakh crore as well as the revised estimates of 16.50 lakh crore. The net direct tax collections have exceeded the budget estimates by almost 17% and revised estimates by 0.7%. So good news there. Meanwhile, the provisional gross collection of direct taxes before adjusting for refunds for 22-23 stood at 19.68 lakh crore, an increase of 20% year on year. This means that refunds worth 3 lakh crore were issued in financial year 23. Now, of the 16.61 lakh crore mop-up corporate tax collection for financial year 23 stands at 10 lakh crore, and personal income tax collection, including securities transaction tax, the STT, is at 9.60 lakh crore. Karthik, what do you make of these numbers?
See, again, these numbers take me one step forward in trying to reason out why the World Bank thinks consumption in India is ever going to fall down. I mean, look at the numbers, both direct as well as indirect. Indirect, of course, in terms of GST, the hike has not been that significant, but yet a hike. So, indirect tax collection, GST was at 13.3 lakh crore, whereas it has now gone up, and that was in the revised estimate. And the actuals, of course, the filed actuals right now are amounting to about 13.85 crores, which is also an estimate. But that beyond, look at corporate tax. You see a great 17% jump there. These are companies who are filing corporate tax. These are companies which are filing this corporate tax on the basis of their profitability. And these are companies which are obviously making profits because of the fact that they are selling more. Now, whether these happen to be B2B, B2C is immaterial. The fact is that these companies are making profits. And if they're making profits, there is obviously consumption. And if there is consumption, there are people who are buying the products that are being manufactured. And on the income tax, the individual income tax front as well, you're looking at what? A massive 24% hike. So you've got collections go up to 9.6 lakh crore versus a revised estimate of 7.7. So that's a significant 24% jump. So how will consumption not happen in an environment like this? I really am interested in finding an answer to.
Okay. I'm not sure if Abhishek is with us at this point in time. Okay, but you know, interesting point there that our tax collections have crossed both the revised estimates and the original estimates.
That's
both
right.
have been surpassed.
That's
Augurs well for the government and the country at large.
Augurs well. See, I think the fundamental motive that the government had to widen the tax base is finally showing its effects now. So we are in a comfortable position as any projections that are made on the revenue side for the government are made solely on account of taxation, because that is prima facie the only source of revenue for the government, right? Okay. So when you talk about any sort of fiscal prudence, you talk about any fiscal deficit, it is revenue minus expenditure. So if revenue through direct as well as indirect taxes is mopping up, it augurs well for the fiscal account deficit, which hopefully someday could turn into a surplus as well.
Abhishek is joining us at this point in time. Abhishek, thanks very much for taking time. What do you make of the fact that our collections have surpassed the budget estimates and the revised estimates? Is it a surprise or was it something you were expecting?
No, I think the economy is doing well. That's the good news. And I think, secondly, people have realized that paying taxes in advance and on time is much important. And if you see, the tax collections, and if you see the advanced tax collections in the fourth quarter, the numbers are very encouraging. So I think a lot of people, in fact, when I spoke to a lot of, individuals and big clients, they were making payments even on 31st of March. So I think they want to save on the additional brunt of interest on these taxes. And hence, a lot of taxes have been complied and have been paid in the last month, which is very encouraging. So, and I think on the other side, to be very honest, the economy is bouncing back. The incomes are growing up. And unfortunately, there is 37% surcharge on the income group of more than 5 crores. And I think people in that category have ended up paying a lot of high taxes, but which will be, there will be some respite in the next financial year because that surcharge has gone down from 37% to 25%. But yes, overall, encouraging figures. The budget estimates and the revenue estimates at the beginning and in the middle of the year, which were estimated, the collection figures have all surpassed. We must also consider that even the indirect tax collections on the GST front has increased. So overall, tax buoyancy has improved, and I think good to cheer.
Make of the fact that the difference between the corporate tax payers as well as in terms of volume as well as the individual taxpayers is next to nil. Corporate tax collection stood at 10.01 lakh crores versus 9.6 lakh crores for individual tax collections.
Not even a lakh crore difference there.
Hardly any difference. So individuals driving the economy, government's revenue in as much force and as much measure as corporate India?
So I think, to answer that, yes, the gap is less, but I think to me it sounds great, because what is happening is that even if you see a corporate structure and even if the individual salary in that corporate structure will increase, the individuals will end up paying more income tax and the corporate will end up paying lesser of taxes because they would claim the deductions of the incomes which are generated of the individuals there. So from that perspective, the balance is good. What also happens is that when the individuals are paying more taxes, which means that they have more purchasing power, which means that more circulation of money will happen, more spending will happen. So from that economics perspective, I think it is good. But yes, overall, this difference is shrinking.
But Abhishek, on the contrary, how do you read, let's say, what the government announced, what the finance minister announced in the budget, that up to a salary of 7 lakh in the new tax regime, there's going to be no tax to be filed. Now, the fact that we are talking about a fairly young population in India, we are talking about a lot of first jobbers getting added to the workforce every year. And willy-nilly, there would be perhaps, the first drawn salary across a lot of cities, a lot of sectors in India would be well within the 7 lakh INR threshold. So in light of that, do you see people opting for the new tax regime? Will the government see a little lesser mop up in individual tax collections end of the year?
No, I don't see that for sure. The direct tax collections will increase certainly in the year ahead also. We know for a fact that this under the new tax scheme, the threshold is now 7 lakh rupees, and I think that is very fair, because I think you would make this class of people with more purchasing power, so they would end up spending more. And every spending which they will do, there will be GST on that. So the government will get revenues from somewhere or the other. So I think 7 lakh is a very, very pragmatic approach. Also, if you see the surcharge on income of more than 5 crores has also decreased in the next financial year from 37% to 25%. So right. While, the lower income group category, the higher threshold, and also on the high income group, some relaxation. But believe me or not, this would not disrupt the collections as far as this government is concerned. There'll be better compliances. I think there'll be more income generated. The economy is doing well today. So I think from that perspective, the compliances have improved. So people are ready to pay more taxes. People, want to keep their books and accounts clean. So I think the mindset is changing. And when this mindset is changing, I think the country is going in the right direction. So I don't see there is any reason to worry on the income tax collections from that perspective.
Okay, Abhishek, before I let you go, quickly, up until the last month, we were short of 50,000 crore to meet the budget estimates. We now know that we've exceeded. Seems like there was a spike, as you were alluding to earlier, in the last few days and weeks. How do you read this?
So I think, frankly, last 3 weeks of March, the collections have been very good. A lot of people did compliance from 10th of March till 15th of March. A lot of my clients who reached out to me said that, they do not want to have additional brunt of this interest, and they want to comply by making, payments of advanced taxes. In fact, there were a lot of people who were doing calculation towards the end of the March also, so that most of the tax is paid in the existing financial year, I mean the financial year which has gone. So a lot of taxes were also paid on 30th of March and 31st of March. In fact, if you see the government data portal, a high amount of tax was even complied and paid on 31st of March. Because if you do so, you end up saving some interest on the taxes paid on 31st of March. So I think people were, doing their calculations very honestly and diligently so as to pragmatically reduce the brunt of interest on this taxes, which in any case becomes then payable at a later stage at the time of filing of the return.
So Abhishek, widening the tax net, more number of taxpayers, added overall tax collection high, augurs well for fiscal deficit? Likely to turn into a surplus anytime?
So no, I think it would not turn into a surplus that easily. See, we must understand that even if the revenue collection is high, the government will not stop, these projects which are there. The fiscal deficit will certainly improve because the revenue is increasing. But at the same time, the government has a lot of ambitious investments and a lot of infrastructure projects to complete in 2023, 2024. So I think this enhanced revenue collection will help Finance Minister to basically pump in money for those projects, give some incentives for closure of these projects and so on and so forth. So I think fiscal deficit, she would want to keep a pragmatic balance between the expenditure and the revenue. But I think fiscal deficit will improve, but I don't see it will become surplus.
Right.
Okay. And all of this, while we continue to discuss, Karthik, India's tax net is relatively smaller. We are increasing about 6 crore Indians pay taxes.
That's right.
Over 6 crore Indians.
That's right.
It's fast increasing, but not there yet. We continue to make strides.
We shall overcome.
We shall overcome. We continue to make strides as far as expanding India's tax net is concerned. But the latest data augurs well for India and India's direct tax collection figures. We will continue tracking that story and more. Keep watching Business Plus.